So we'll wind up the remaining portion of free cash flow valuation. That was reading number 36 of the CFA curriculum. So just to refresh, there were various ways in which we could calculate the free cash flow to firm and the free cash flow to equity. Starting with net income, add the non-cash charges, add back the interest, subtract the capital expenditures and the working capital investments. If you're starting from cash flow from operations, then again you'll have to add back the interest that would have been deducted and subtract the fixed capital investments or the capex, because working capital is already reduced in CFO. Free cash flow to firm is the cash available to both equity and debt holders. Free cash flow to equity is the cash available only to equity holders. So from the free cash flow to firm, we will again subtract the interest and add the net borrowing, if any, to calculate the free cash flow to equity. Now, a lot of times, firms want to maintain the target debt equity ratio while expanding. And hence, while forecasting, you must also ensure that if the company is doing capital expenditures, then the funding will be such that the debt equity ratio has to be maintained. For example, if a company does a fixed capital investment of a particular amount and the company has a fixed debt to assets ratio that the company wants to maintain. We studied that from the capital structure, or that is what the company feels is optimal. So if that debt to assets ratio has to be maintained, then whatever investment is happening, a part of that investment has to come from debt and a part of the investment has to come from equity. Of the total asset investment of A, if the debt to assets ratio that we want to maintain is DR, then A into DR has to be the amount of debt in the company if A is the total assets, and the remaining will be the equity. The assets are funded by debt or equity. So the free cash flow to firm otherwise is simply net income. We don't need to subtract the interest because now it's, or we don't need to add back the interest because now it's free cash flow to equity that we're estimating. But we will add back the non-cash charges, that is mainly depreciation, and we will subtract the working capital investment and we will subtract the fixed capital investment. However, FCFE also has an addition to the extent of the net borrowing. Please understand the proof carefully. The books just give the formula, they give no explanation. So when I know that a target debt to assets has to be maintained, there is some estimation of the net borrowing that I can do. So if fixed capital investment additionally is to the extent of FC, then overall assets will increase to what extent? To the extent of FC minus depreciation. So the additional debt that needs to be taken or that needs to be added would be FC minus debt into the debt ratio, because at any point in time all the new assets can't be funded by equity. Some loan has to be taken. If DR is the debt to assets ratio, then this much additional borrowing must happen because this is the increase in assets. Similarly, for the total working capital, if WC investment is being made as an expense, then a part of this has to come from debt. Again, DR into the working capital investment has to come from the debt. So this entire sum will now be our free cash flow to equity. This is the same formula as before, but free cash flow to equity has net borrowings added. And if we are maintaining a debt equity ratio, then we are adding some debt and that debt can be added. So to whatever extent we are increasing our assets, a part of that has to be debt. To whatever extent we are increasing our working capital, that's also current assets. A part of it has to be debt. So you don't need to know the proof. The curriculum doesn't give this proof as we have discussed. So eventually you may want to remember the formula unlikely that institute will test you on formula based questions, but you can understand that how FCFE will be impacted if you want to maintain a target debt to assets ratio. Now, the valuation using free cash flow methods is exactly the same as we did with dividend discounting. The only issue is calculating the free cash flow, is an example of which we did in the previous session. However, just for repetition and better understanding, let's try to do a valuation once again. It will be very similar to what we did in dividend discount, and let's understand the process again. So Korea Hydro Corp has a most recent free cash flow to firm of $10 million. The target debt to equity ratio is 0.33. The market value of the firm's debt is 20 million, and KHC has 4 million shares of common stock outstanding. The tax rate is 40%, and the shareholders require a return of 20% on their investment. The firm's before tax cost of debt is 10%, and the expected long-term growth rate in FCFF is 10%. Calculate the value of the firm and the value per share of the company. Remember, firm value will always be the free cash flow to firm discounted back at the weighted average cost of capital. Equity value will be free cash flow to equity discounted back at the cost of equity, or we can calculate it from the firm value by subtracting the value of debt. Now, the FCFF in the most recent year is given to be $10 million. And we are told that the FCFF will grow at the rate of 10% sustainably. So here it will be into 1 plus g into 1 plus g to the power 2, so on and so forth. The firm's before tax cost of debt is 10%. The cost of equity is 20%, and the debt to equity ratio is 0.33. So let's calculate the WACC. It will be the weight of debt. Please note, D by E is given to be 0.33. Weight of debt is D by total assets, or D by D plus E. So let's assume this was 0.33x, this was 1x. So weight of debt would be 0.33 upon 1 plus 0.33 into the cost of debt, that is 10%, into 1 minus the tax rate, that is 40%. So it will be into 0.1 into 0.6 plus the weight of equity, that will be 1 upon 1.33 into the cost of equity of 0.2, that is 20%. So that comes out to be 16.52%. Now, we know the cash flows, we know the discount rate. The situation is quite similar to the Gordon growth situation, except that instead of dividends, this is now a free cash flow to firm. So the terminal value, or the value at t equal to 0 in this case, would come out to be FCFF1, that is the next year's, because recent you won't get again, divided by the WACC minus the G. The proof is exactly the same as the Gordon growth proof or the dividend discount model. So 10 million was the last year's, into 1 plus 0.1 was the growth, divided by WACC of 16.52% minus a growth rate of 10% will give us the answer, which comes out to be $168.71. So that's the first part, that is calculate the value of the firm. The second part asks us to calculate the per share value of the company. Now the value of equity is simply the value of the firm minus the value of the debt. Value of the firm we calculated as 168.71 million minus the value of the firm's debt, and remember we must take the market value, is $20 million, because if today I want to retire the debt, I want to buy this company and pay off the debt, I will have to pay the market value. So this will give us the value of equity, and to compute the per share we need to divide it by the number of shares, that is 4 million, which will give us the per share value of the equity as approximately $37.18 per share. Super Cement has a free cash flow to equity of 5 USD per share and is currently operating at a target debt to asset ratio of 0.33. The expected return on the market is 10%, the risk-free rate is 5%, and Super Cement has a beta of 2. The expected growth rate of FCFE is 10%. Calculate the value of Super Cement stock. Now once again, we're asked to do a similar sort of a calculation, but now it is the free cash flow to equity that is given. So if we discount back free cash flow to equity, first of all we have to discount it back by the cost of equity and not the WACC. And secondly, this discounting will give us the value of equity, not the value of the firm. So at t equal to 0, again we are given that the historical free cash flow to equity has been 5 USD per share. At t equal to 1, this will grow at the rate of 10%, or it will become 5.5, so on and so forth until infinity. The beta is given, the risk-free rate is given. I can apply the CAPM to compute the cost of equity, or the cost of equity will come out to be RF plus beta times RM minus RF, that will be equal to 0.05 plus beta into RM, that is 10%, minus RF, that is 5%, which will come out to be 0.15 or 15%. So again, I'm given the discount rate, I'm given the cash flows. I can compute the value of the equity as FCFE1 upon KE minus G. FCFE1 will simply be 5 into 1 plus 0.05 divided by the cost of equity minus the growth, that is 0.1. Apologies, the growth rate is 10%, not 5%. So 5 into 1 plus 0.1, that will be 5.5 upon 0.05. That is equal to $110. So this is the value of equity per share. Now just like in the dividend discount model, we had a 2-stage, a 3-stage, an H model. All the possibilities remain with free cash flows as well. So in a 2-stage free cash flow model, we have a high growth stage, after which the company matures and the growth plateaus out to a lower number. So the Northern Nickel company earned a net profit margin of 10% on a revenue of $50 million this year. Fixed capital investment was $1 million and depreciation was also $1 million. Working capital investment equals 4% of sales every year. Net income, fixed capital, depreciation, interest, sales are all expected to grow at 10% per year for the next 5 years. After 5 years, the sales growth, net income, fixed and interest, so all items again will grow at a stable 5% rate per year. The tax rate is 40% and Northern Nickel has 2 million shares of common stock outstanding. Long-term debt has an interest of 10% and the par value is $50 million. Calculate the value of the firm and its equity using free cash flow to firm model if the WACC is 20% during the high growth stage and 10% during the stable stage. So even the cash flows are more risky. So it's very much possible that I want to discount one set of cash flows that are more risky at a higher rate, because discount rate must account for the opportunity cost of capital. And stable growth rates, I have more confidence in my projections. Hence the risk is lower, I'm discounting them back at a lower rate of 10%. So the information is mentioned. We will first project the cash flows for the high growth stage and then the free cash flow to firm for the stable growth rate, and then discount them back to compute the value of the firm today. Now, given that we have the net profit margin to begin with, there are many formulae for FCFF that we can apply. But we know the sales and we know the net profit margin. So what we can try to apply is the net income plus the non-cash charges plus the interest into 1 minus the tax rate minus the working capital investment minus the fixed capital investment. Now let's look at each of these numbers for the next year and compute the free cash flow to firm for year 1, and then we'll see how to go about it forward. Now in the next year, the net income will be the previous year's net income growing at 10%. So the question says that net income, fixed cap, debt, everything is going to grow at 10% for the next 5 years. So in fact, a better way probably would be to first calculate FCFF0 and then project FCFF1 as FCFF0 into 1 plus G. So FCFF0 is net income, that is 10% on a revenue of 50 million, that will be 5 million, that's the net income, plus the non-cash charges, that is the depreciation, which was given to be 1 million, plus the interest into 1 minus tax. So 10% into 50 million would be 5 million of interest. However, interest does give us a tax benefit, so into 1 minus 0.4 will need to be added, minus the working capital investment. So working capital investment is 4% of sales, that will be 4% of 50 million, that is 2 million, and a fixed capital investment that is given to be 1 million. So this will give us the free cash flow to firm in year 0. So it will be 5 plus 1 6 plus 3 9 minus 3 6. So in year 0, the free cash flow to firm is $6 million. That is what has been given. Now fortunately, all the items that comprise the free cash flow to firm, net income, depreciation, interest, working capital investment, fixed capital investment, net income, fixed capital, interest, depreciation, are all being given to be increasing by 5%. Rather 10% initially and then 5% every year after 5 years. So it's relatively easy to project FCFF1 because if each of these items grows by 10%, FCFF1 will simply be FCFF0, that is 6 into 1 plus 0.1. So depicting the timeline for this question is now fairly straightforward. At t equal to 0, we had a free cash flow to firm of 6 million. Please note, this will not come in the discounting. This is not the cash that we will get. If we purchase the stock today, we will get all the cash coming from year 1. So at t equal to 1, this will be 6 into 1 plus g, t equal to 2, 6 into 1.1 square, 6 into 1.1 to the power 3, 6 into 1.1 to the power 4, and the t equal to 5 cash flow, whatever it is going to grow perpetually at the rate of 5%. So the cash flow at t equal to 5 would be 6 into 1.1 to the power 5. The growth rate is 10%. From t equal to 6 onwards, the growth rate comes down to 5%. So we can apply the Gordon growth formula here, which will make the present value at t equal to 5. Please note the present value is for 1 year. earlier. T equal to 6 is our D1 now. So the value at t equal to 0, that is t equal to 5, would be 6 into 1.1 to the power 5 into 1 plus 0.5 upon 0.1 minus 0.05, which will give us the terminal value. We then need to input all these parameters into our cash flow sheet and calculate the value at t equal to 0. So enter CF1 as 6.6, which is to be discounted back by 20%. CF2 as 6 into 1.1 to the power 2, which has to be discounted back by 1.2 square, so on and so forth. CF5 will be 6 into 1.1 to the power 5 plus the terminal value that we have calculated as shown. Cash flows after t equal to 5 are being discounted back at 10%, and cash flows before t equal to 5 are being discounted back at the rate of 20% as given in the question. Which gives us the present value as 104.44. This is the value of the firm. So just to summarize, free cash flow to firm is the cash flow available to all of the firm's investors, that is shareholders as well as bondholders, after all operating expenses, long-term investments have been made. Free cash flow to equity is the cash available to common shareholders after funding capital requirements, working capital needs, and debt financing requirements. So if it's a net borrowing, it will be added. If it is a net repayment, it will be subtracted to calculate the free cash flow to equity from the free cash flow to firm. The value of the firm is the present value of the expected future FCFF discounted at the WACC. The value of the firm's equity is the present value of the expected future FCFE discounted back at the return on equity. FCFE is easier and more straightforward to use where the company's capital structure is not very volatile. So if debt equity is going to be constant and you are at a stable optimal debt equity, then you may as well use FCFE to calculate the value of equity. So if FCFE is negative, or if the debt outstanding is highly volatile, or there's too much debt that is going to come down, that means the current capital structure is not stable. Then it is better to use the free cash flow to firm. That will give us a better picture about the company's assets.